Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're doing okay, and I hope you'll check us out at jazzwealth.com. We're a small company, small financial advisor, trying to compete with the big boys out there, but we do that by doing more for you and trying to make sure everybody's on the right track for retirement. We do all kinds of great things for our customers, including weekly classes similar to this, but where we go more in detail. Today I want to experiment. Well, I want to expand on something that I've talked about here recently, where we've been focused on, like, if you're picking dividend stocks, not necessarily just picking them and saying, oh, hey, they pay a high dividend. That's exciting. I think I'll buy that. What we want to do is focus on whether you're a dividend growth investor or a dividend income investor. I want you guys to take it further here. 2020 has been a challenging year so far, and I want you guys to challenge yourselves even more because just picking a dividend stock could be doing you a disservice. And so I've got a really rough sort of example to share with you today. Got a lot of positive feedback on our last one, even though we had audio issues. And so I want to expand on that, and I'm going to continue to do this for you guys. I welcome the comments below in terms of what you'd like to see. We have access to every ounce of data out there these days. So if there's something we can expand on, of course, let me know. So let's get started. Let's just assume you want to be a dividend investor. The first thing you're likely going to do is scan for dividend stocks. So here we go on the screen. You've got a list of stocks that we kind of fall into the high dividend index here for the S&P 500. We wanted to simplify this and make it as little of results as possible. So I just did a quick scan and we came up with 64 stocks in the S&P 500. I then added a few little criteria here just to show volatility over the last 30 days because we've had a lot of volatility. I want to show that on the charts. And then we did the standard deviation of their returns. In other words, if you're looking at returns overall for these different stocks, what's the range to be expected? 1 year, you're up 1%, down 1%, etc. We look back 5 years, but to be fair, I would look back over 1 year to see the most recent volatility because over the last 5 years, we really haven't had a lot of volatility. Anyways, so what I did is I sorted these by the standard deviation of returns. And then we said, okay, these have the lowest wiggle. Let's just say wiggle for lack of a better way to say it at the moment. These have the lowest amount of wiggle up here. And then as you go down at the list, these stocks wiggle a little bit more. And in fact, if you go over to the next page, there you go. Here would be the stocks that wiggle the most. So Williams companies, you can go all the way up the list, Haynes brands, etc. What we did is we randomly picked the stocks down here that are considered more volatile, and then we randomly picked the stocks up here that are less volatile. We tried to make them more diverse. The goal here was to try to get funds that had a very similar dividend yield. I wanted to build a portfolio. So what I did is I built a portfolio out of 10 of each of those stocks, 10 of the lower volatile ones, 10 of the higher volatile ones. And we came up with dividend income, which is up here. This would be your lower volatility stocks that still pay a respectable dividend. And then we went to adding ones that had more volatility. Those would have been at the bottom of the list. Now, just looking at a chart, you can't really see the volatility difference. If we look at the purple line, you can see it's a smoother overall run, meaning day by day it's a little bit smoother. If you look at the orange line here, you've basically got more jitteriness, more back and forth, but it's not as pronounced. It doesn't really stand out as something that's super crazy or excited. So let's look at each individual portfolio itself. The first was the dividend income portfolio that had very low volatility. The way we can highlight this is the standard deviation of the returns. In other words, if you equal weighted 10 stocks out of this list, like Verizon and Pfizer and General Mills and stuff, and you said 10% to each one, I'm going to buy 10 individual stocks, your volatility in the portfolio over the last 5 years would be plus or minus 12%. What does that mean? Well, basically, it means that at any given point, you would have seen a 12% gain versus a 12% loss. The range between highs and lows are about 12.4%. What we'd like to do is keep that as little as possible if we're looking for income. Because if you're a yield player, you're buying dividend stocks purely for the income, you don't care about the growth in the stocks, well, you're more interested in that consistent yield. You don't want to wake up one day and see that you're up 20% or down 20% in terms of the overall portfolio. That's the important thing to focus on here. So this first portfolio, we've got a range of about 12%. Dividend yield in total is about 5%, and this was the real focus for me. I was trying to get something very similar. I wanted two very similarly comparable portfolios, and we've got a 12% range here. So 5% yield, there's no expense ratio because these are all made up of individual stocks, and it's not really anything in particular like an ETF or something. Here are the holdings that we came up with. These are not recommendations in any way. Like I said, we randomly chose these just to try to show lower volatility. You've got 10% holding, meaning you took 10% of your portfolio. In other words, if you had $100,000, you took 10,000, put it here, 10,000 here, 10,000 here, and just sort of blindly bought these. All right, so that's what we have there. Now, going back to the quote page here real quick, we're going to take a look. Just keep this in mind. 5% yield, 12.4%, max drawdown about 25%. That's all going to come here during this virus decline. You can imagine a lot of things took a bit of a hit here. Average annualized returns about 12%, and we showed the holdings and everything like that. Now, what we're going to do is go over to the bottom of this list here that are more volatile stocks, irrespective of their dividend yield. What we tried to do was put together a list of portfolio of 10 stocks that were more volatile. So here's what you got. Dividend yield is basically the same. You got a little bit higher yield, but it's negligible in comparison to what I'm about to show you. The standard deviation of returns about 23%. That's about double. You didn't double your yield, but you doubled the volatility. So again, what I'm trying to say there is now when you wake up at any one point relative to the current price, you've got 23% plus or minus. The last one was 12, right? So if you're not so concerned about volatility and you don't care how much these stocks wiggle around, then this portfolio would probably be just fine for you. You wouldn't really care. But as a dividend income investor, what you're focused on is the least amount of volatility possible. So let's take a look. You've got 23% here, volatility, max drawdown 50% in this portfolio, and the average returns are actually worse. So you're worse off looking for about the same dividend yield, but going with more volatile names. So look at how much of a disservice you've already done yourself just by simply picking random dividend stocks there. Not too good. Here's the holdings of those individual portfolios. Again, just randomly chosen here. CenturyLink, you got MetLife in there, you got some REITs in there, you got an oil stock, all 10% to show equal weighted portfolios. Okay. What's the moral of the story here today? Because this is kind of an interesting one. When you look for dividend stocks, don't just pick the dividend stocks out there. Look for ways to lower the volatility, or if you're not concerned with volatility, of course, you could just certainly pick any old dividend stock that you're comfortable with them likely continuing to pay the dividend. This is a big one. This is something that we focus on a lot in our portfolios because I can't afford to tell customers your portfolio was way up here one month, way down here one month, but the yield was the same, right? You basically got the same return. Can't do that. We manage our own portfolios here at Jazz Wealth, and this is one of the things that we like to focus on to really tighten up the returns for our overall portfolios that you could see right on our website. I do appreciate you checking it out. Let me know if everything went well this time. If you like this sort of video, we're trying to take more of an approach where we go through a portfolio building approach where you guys think about things further rather than just saying, what about this stock? What about this stock, etc. So I hope that was good for you. I hope you learned something. And if so, let me know in the comments below. Maybe hit the subscribe button, or more importantly, check us out at jazzwealth.com. You can even schedule a call to speak with us. Happy to help. Enjoy your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.